This is the IPRG partners discussing the market. We're here in August of 2022, and sitting in this room we have Adam Lobel, Luke Sproviero, Steve Reynolds, and this is Derek Bestreich. And we just wanted to go over what we're seeing in the market right now. A lot of moving pieces with interest rates and rents and market volatility. And it's also the summer, so are people on vacation? Are people looking to buy? And just wanted to go around the horn a little and just talk about what we're seeing, what's interesting, what's affecting the market right now. But the guys wanted to kick it off with interest rates and rents. So who wants to jump in and express what we're seeing at this time?
Steve, you want to start us off?
Yeah, so with interest rates and rents, I mean, it's probably the hottest topic in the market right now. I don't think I've had a conversation with a buyer or seller who's not talking about it. On one hand, rates are rising at a rate where I haven't seen in my career over the last 10 years. Mortgage rates, correct. And then rents are absolutely skyrocketing.
So hang on, I'm gonna just interject real quick. I want to put some context behind this, okay? So you say mortgage rates have risen more than you've seen in your entire career.
Yep.
So just so we're all clear on what the rise in interest rates was, how much did interest rates rise over the past year?
I'll start that. I mean, I think there were times, especially in late 2020, when rates were under 3%.
For multifamily?
I mean, there are definitely people locking in rates. I heard it 2.8, 2.9%. Obviously, residential rates, I heard, obviously 2.3, 2.4, 2.5, but I haven't heard any commercial rates there. And I think going into 2021 for big part, it was low threes. I think,
and where are we at in the summer of 2022?
So I was speaking to somebody yesterday, and they are locking in a rate at like 4.7, 4.8. I've heard
but that's now because rates have come down recently.
Come down.
What were they like last month? Wasn't it like 5.25, 5.5, like some stuff in that range?
So for banks to refinance you out of buildings, I think it's low to mid fives.
So rates are up at least 2% from where they were, if not more.
100%.
Or at least over the summer of 2022, rates are up 2%. All right,
yes.
Steve, now we're going to talk about rents because you say the rents have gone up astronomically. So what does that mean? Like, let's just use 2022 as an example, like going back to January of this year, or you can even go back to 2021 in the summer, a year ago. Those are two different time frames.
Yeah.
How much do we think rents are up in the past 1 year, and how much do we think rents are up year to date?
So it's kind of a loaded question in my opinion.
For sure.
Because the summer of 2021, you're coming out of the pandemic.
Yeah.
I think based on where rents were there, where people were basically begging tenants to rent their apartments, to where we are now, you could say they're up 100%. From that time period, in some instances, they have doubled.
I'm sure they are.
There's a number of instances where they doubled.
It's
artificial. Rents have doubled in the past year.
There's instances where they have doubled.
But
it's
I think
artificial,
it's artificial
100%.
because if you look before the pandemic, I think we're up like 20 to 30% in most instances. And one thing to mention, not only they're renting out in like a weekend.
I mean,
so there's no vacancy. There's nothing on the market.
There's two bedrooms. Like, talk about the East Village for a second. There are two bedrooms that couldn't get 2,500 during COVID. They couldn't get it. They're taking less, and those same apartments are asking 5 today. So that is double.
I think Manhattan's seeing a huge, like Adam, what are you seeing in Manhattan?
Yeah, I think the reality is that the core markets have increased probably 15 to 25%.
In what time frame?
Call it the last 3 to 4 months alone. I think there's just an overall supply-demand imbalance in the city, and especially given the 19 rent law changes and with no 421 abatement, I think there's just a huge lack of available inventory to rent out, and I think the rental market is pushing to all-time highs. I know even for myself, who I live in Union Square, I rent a one-bedroom. The pre-COVID rent that Steve was talking about was $800 less than what I'm paying today, and I still think that I'm probably $1,200 to $1,500 under market for my one bedroom. We're seeing across the board, even on the listings that we're working on, as we've taken the listing and the renewals are coming up, every single owner we're working with is telling us they're getting the highest rents they've ever gotten, and the units are renting out in less than like a day. There's lines out the door for some of these free market.
Lines around the corner.
Yeah. So I think that's really driving the rental market, and I think that the market is, I think in the core areas, I still think has a lot of steam. to continue to grow.
Even what is driving the rental market? Like who are these tenants, and like why are the rents so high? Is it just all come down to lack of supply? Like rent stabilized units off the market, or no new construction 421A? Like what's driving?
Are we talking high end areas? Are we talking about what are we talking about?
I think we're just talking about free market product in Brooklyn, Manhattan, and Queens.
So my take on that is that Manhattan, in particular, south of 23rd Street, is a special area in the country. I think that no matter what, it's always going to be special. Units are always going to be in high demand. They're always going to rent out very quickly. I think the units in the core areas of Brooklyn, the Williamsburgs, the Greenpoints, the Park Slopes, the Cobble Hills, the western locations, I think really what's driving the rental market there is just an overall supply-demand imbalance across the entire market. And I think people have gravitated towards these areas to be close to the city. And I think that's ultimately what's really creating the rise in prices.
Hear me out here, though, which even in these higher areas, right, like in Manhattan is crazy, especially so good areas of Brooklyn and good areas of Manhattan. I think interest rates are driving rents higher than they've ever been. Interest rates are driving rents higher than they've been in the core areas. I mean, just today I saw on the news that the average rent in Manhattan surpassed $5,100, which is insane. And I think it's all because rates are skyrocketing. These not high net worth individuals, but these high income individuals are now saying, okay, now these $2, $3, $4 million homes don't make any sense anymore because their monthly payment's going to be too much because of interest rates. And now they're pushing hard into the rental market. So this luxury rental market, I mean, you're seeing prices. I mean, I feel like in core Manhattan, for a 2-bedroom, you can't be under double digits. It's $10,000 and up for 2-bed, 2-bath product in core Manhattan.
So if Lower Manhattan is so special and you're seeing these double-digit rents in Manhattan, and you're saying that with interest rates being higher, the condo market or whatever the housing market is becomes unaffordable. So are these families, high-income renters pushing towards Brooklyn, and is that impacting the pricing in Brooklyn and the demand there as well?
I mean, I think over the years we've seen that push into Brooklyn regardless of where the rates are. I think people saw it as an opportunity to get more space, get a better quality of housing stock, and I think it's just you're continuing to see it. I mean, week after week, you're seeing the top deals signed in New York or in Brooklyn.
For what?
For brownstones, like core, like these beautiful brownstones. And I think anytime you have extreme highs in any aspect, you're going to have a trickle down effect. So if they can't afford the Primus area, which Adam said was below 14th Street, you're going to see it keep pushing further and further out. And that's what you're seeing in Brooklyn.
So how does that impact like the tertiary markets, like say Bushwick or Bed-Stuy or Crown Heights? Like, are we talking about the rent growth there and the demand there, or are we simply talking about like the core, like prime neighborhoods?
Yeah, I mean, you're seeing it. I was having a conversation with an owner that has a couple hundred units in those neighborhoods you just mentioned, and he made a joke. He's like, I don't even know what to put these on the market anymore. Yeah. He's like, I put a 2-bedroom out there for $3,000, I got it in a day. Mm-hmm. He's like, I put it for $3,500, I got it in a day. If you asked me 6 months ago, a Bushwick 2-bedroom getting $3,500, I'd be like, okay, dude, like get out of the room.
But saying that, going back to the sales side, like on a condo sale, I think interest rates are going to decimate these tertiary locations of Bed-Stuy at Bushwick, because I mean these are people that are buying 1-bedrooms for under $1 million, call it $500 to $700,000, and an increase in an interest rate to them is a few $100s a month, which is going to hurt them. They're not buyers; they're going to rent, and I think the condo market's going to get really hurt in these locations, and you're going to see rents go up in these locations too. I honestly think that's what's driving this. I think interest rates are pushing people out of home buying, and it's going to just make it more competitive to rent apartments, and for a number of other reasons, which I'm sure we'll touch on. They're not building them like they used to. There's not the supply.
So, do you have something to add, Adam?
Yeah, I was just going to say, I think one of the big themes in COVID was really a flight for space, right? And obviously a lot of people were selling condos in Manhattan, in Manhattan buying townhouses in Brooklyn. They were selling their Harlem, townhouse and moving into downtown Manhattan or whatever it is, right? So obviously the Brooklyn, called the Brownstone, Cobble Hill, Carroll Gardens, Park Slope, the 1 to 2 family, 3 family free market part of the market has skyrocketed. And
with outdoor space.
yeah, just because you can get more space. And I think, I guess the question is like, where do you guys see that market headed if what you're saying is not as many people are going to be selling condos and there's going to be actually more renters?
You're talking about rental demand?
Yeah, rental demand. And or like just that purchasers
rental demand is very high. And as Luke is saying, if housing becomes unaffordable because of interest rates, even in like the suburbs or like whatever that is, I mean, you have this whole millennial cohort of people that, are all getting older, they're getting married, they're starting to have families and kids, like they need more space. And it's really a big debate that they're going to have. Are they going to move to the suburbs and commute and try to get more space that way? Or are they going to stay in the city and rent and try to get more space here? But I think that all contributes to just the sheer amount of demand for and just a lack of supply of units in these locations where people want to be. So it's a somewhat tough predicament for these young families and these renters where like the rents are just skyrocketing to extremely high levels, and the affordability of houses in the region is not great with the new interest rates. So I agree with you, Luke, that a lot of these people are going to stay as renters in the city, and they're just going to bite the bullet and pay the higher rent, and that's going to be that.
Yeah, I mean, I don't see it changing anytime soon. I know when this started, call it 6 months ago, I got a lot of heat for it because it just kept rising. I don't see how it can...
Heat from us, not so much other people.
Other people.
You and I debate this all the time.
We debate it all the time, but like people are like, how can rent keep going up? And my opinion is until something drastic happens, whether interest rates are back to where they were or the rent laws change and you promote new housing through abatements, nothing's going to change.
Is there a scenario where we've seen a lot of inflation, right? We've seen rents rising. We're at new rent thresholds that we've never seen before. Is there a case for deflation on the rents where the rents pull back down because maybe we swung too far to the upside this summer?
It's starting. I'm here.
You think so?
I don't think rents are as strong as they were a month ago.
I think that we set new rent thresholds, and these are going to be the new rents. I think the value of the dollar is a lot weaker than it used to be, and it doesn't mean that it costs more. It's just a different number.
I think there's locations where that's true, where we definitely, like a Greenpoint, there's been a new base. And a lot of landlords, a lot of people that own in Greenpoint, unless they had rents that came up in the last 8 months, 6 months, now they're seeing it, but they're surprised. The rents are huge, but it makes sense. A 2-bedroom going for $5,000 that's gutted in Greenpoint makes sense.
You and I were in a unit last week. It was a floor-through unit in a brownstone, and it was a huge space, but that tenant's paying $8,000 a month in Greenpoint.
And that owner thought it was insane. I was like, you got $8,000 for a renovated floor in a townhome, but you know what? I walked that, and I live on 11th and 5th and 6th, and that in Manhattan, that looked like a bargain. So that to me makes sense. But there's markets like a core Manhattan that something's got to give. I mean, the rents are astronomical. But like Greenpoint, I do think Greenpoint, Williamsburg are two markets where I think you see a new benchmark.
Something's got to give, but people are paying it, and there's a lot of jobs and income in the city right now. Yep. And landlords I've been speaking to, like they say that first of all, the tenant files they're getting, these tenants are like from all over the country. Like people are coming back to New York in a big way. I was on the phone with a different landlord recently. He told me and this is in Williamsburg. He told me he got his first $1 million tenant. So he has
What does that mean?
Meaning that he has a tenant that applied to rent a unit in his building that has $1 million per year income, renting, I think it was a 1-bedroom in Williamsburg. And just like the caliber and the quality and the income on the tenants it's just not what it was before COVID. It's a totally different story.
And rents make sense, Steve. That point you make all the time. The point that if you peel back the onion and you say, okay, you're looking at a house for $2.5 million, and after interest and principal, after your taxes and after insurance, what's the monthly payment? Take away the down payment. But what's your monthly payment to support the debt, to pay the insurance, to pay the tax? It's more than the rent. It's more than the rent.
And you got to deal with the headache of homeownership.
So there you go.
To piggyback off what you mentioned before about Greenpoint and certain markets creating a new threshold, but that in itself creates new thresholds and benchmarks for other markets. If you can't afford Greenpoint anymore, you're going to move to Bushwick.
Yeah.
And that's why I think you're seeing a new, to Derek's point, Rents aren't going down.
Or Jersey City. We're seeing in Jersey City.
Look, I'm a Jersey boy. That's where I'm from.
Yeah.
You saw the other day, it came out an article. Jersey City is the most expensive city in the country. Now, do I believe that? Not necessarily. I don't know where they get all their data from, but rent's high there too.
Extremely
but
high.
It's all these areas that are coming from, to Adam said, south of 14th Street, Manhattan.
Yeah.
And it's just that bubble radius just keeps getting wider and wider.
So what does that mean for a market like the Bronx, Steve? Like, like obviously it's a lot of regulatory units up there. Like there's not a huge amount of smaller free market type of product. Like,
look, I think that's why you still see people buying affordable development plays.
Yeah.
Without the abatement too, they're still buying land because they are also going to enjoy the ride up. If you can't afford the rents in Brooklyn or in Queens or in Manhattan, you gotta go to the Bronx.
Affordable is a big play. I'd make a play in affordable.
There's not enough housing.
Right, but obviously as rates are going up, like cap rates are going up as well. Like where do you see in terms of the values of some of the buildings, the fully stabilized stuff trading at this point?
It's interesting. I mean, look, stabilized is stabilized. I mean, it's almost like an annuity. So unless something changes, cap rates are going to have to rise with interest rates. But
so hang on.
Yeah.
On rent stabilized, do we think cap rates and interest rates move in tandem?
Yeah.
On rent stabilized?
I think you have to at this point.
How about on the free market?
So that's where you have this quagmire, which I'm seeing a lot of interesting things in the market that are actually surprising me because for the first time ever, yes, interest rates are higher than we've seen in a long time, but we're still in a low interest rate environment overall. And you're seeing this rental growth, and we're all sitting here saying we think it's a new threshold. You would think people would be diving into the market extremely excited.
So here's the question that I want to ask. Like talking about the free market properties, not the rent stabilized, because I agree that cap rates and interest rates on rent stabilized move in tandem. But on the free market side, you have interest rates that are up, call it 2% in the past year, if not more. And you have rents that are up, realistically, they're up like 30 to 40% based on like where they were. So rents are up a lot, interest rates are up a lot. And the question is, which one is winning this tug of war in the free market space between interest rates and rising rents?
So I'll take the first crack at that. So we're obviously actively marketing a 5-building portfolio in the East Village. It's mostly free market. Obviously the rental market in that location is skyrocketing, right? And obviously we talked about call it a 15 to 30% increase in rents over the course of the last 2 to 3 months alone. But obviously given the rise in interest rates, the offers that we're getting on it have basically remained the same, even though the rental market is significantly higher. So obviously the cap rate's going up, but at the same time frame, interest rates have gone up probably 0.5% plus or minus. And
cap rates are up, interest rates are up, rents are up,
Yep.
Values you're saying remain flat.
Values are flat. I think if rates do continue to go up, I think it's really hard to think that the rental market's going to continue to push at a 15 to 25% increase in the next 3 months. And if rates do go up another 0.25%, 0.5%, I think the interest rates could potentially win that battle a little bit.
So I'll let you guys jump in, but I took the liberty of running numbers on this question before the conversation. So I actually have some numbers to back this up, and you guys can let me know what you think. So I ran this on a $5 million deal with, I said, $3.5 million worth of debt. So in terms of price, in terms of cap rate, if you're on a $5 million deal, if your cap rate goes up by 1%, you need the gross income to increase by 17% to offset the 1% difference in cap rates. So I believe on the free market side of things, I think cap rates are probably up around one point on the free market side. But if rents are up, call it 30 to 40%, I think that the rents are winning that battle. I think the value of free market buildings today is higher than it was previously. And I'll give you the numbers on the debt side too. So on the same deal, if you want to have a $3.5 million loan, if your interest rate on the loan goes up by 1% and you want to keep the same $3.5 million, your gross rents need to increase by 11% to offset the 1% increase in your interest rate on the same loan. So just throwing that out there into this conversation to get your take on
You're
that.
betting that the 17%, you think that there's more room in the rents than 17%.
No, I'm saying in the past, okay? Over the course of this year, I think that on the free market side, I think cap rates are probably up around 1%, and I think rents are up in the 30 to 40% range. So I think a building, on a free market building, is worth more today than it was in January, February, March, is what I'm saying. And on the debt side too, I mean, here I said that the rents had to increase by 11% to offset a 1% increase in your interest rate. And so we were saying earlier, we've had about a 2% increase in interest rates. And the rents, again, here the rents are up by more than 22%, that 11% per interest rate, per point. So I think the rents are winning this conversation, like, by far. And I get that the interest rates are, like, slowing down the market a little as they keep going up, but I think the inflation and rent growth we've seen is, like, far outpacing, and I think we're in a very, like, not to say overheated, but it's a hot market. I mean, just getting back to, like, the amount of demand on these rental units.
Listen,
that's where I think we are. And just one more point on that. Like, we sold a portfolio last summer. It was a $27 million deal. It consisted of a number of free market 8-unit buildings. And I was looking at the numbers recently, and those 8-unit buildings sold for around, like, $3.5 million per building, which, like, today feels like a very small number. I mean, that was a notable sale when we made it. But $3.5 million for an 8-family, Luke laughs. And
we're selling one for $4.5 now. I think it's cheap.
Yeah, $4.5 for sure. I mean, these things are going for, like, depending on location. In Brooklyn, we're talking about, like, free market 8 units. These things are going for, like, $4.5 to $6.5 million. So just case in point there, like, the rents are up, interest rates are up, values are up. That's where I see it.
I'm agreeing with everything you're saying. What's interesting to me, though, is you would think, and again, the market is very strong right now. I think we just came off our best month ever in terms of sales and dollar volume and bringing in listings. It just doesn't feel like the market agrees with that statement, though, no matter how many facts you give them. Or they're just using it.
What do you mean?
I think what you're saying is correct. But if that's the case, you would think that we'd be in bidding wars on every free market deal that we're selling, and that's not the case. There's free market deals in certain markets that are going for less than they were going in 2015.
So,
and I'm wondering why.
So I think within the free market asset class, we got to define. Are we talking about, like, renovated, like, permits completed and signed off, like, job is done and new? Or are we talking about, like, old free market units with, like, below market rents that were never renovated? Like, is there a difference between those two product types?
Yeah, there definitely is. I mean, I'm more so talking about the deals that are value add, need some validation.
I think you're also talking about the buyer pool in general, which I agree with because I've noticed it. I agree with everything you just said. But I also think you asked a question, where do we see the market? Where is the market today? Mm-hmm. There's the new type of buyer right now. It's not a new type of buyer. They're the smarter. Now I don't even want to say smarter buyer, but the real buyers are starting to really start buying. And it's not the guys that were buying when interest rates were really low and it was easy to raise money and it was very predictable.
Why do you think that is?
Well, I think right now is a good time to buy. I think values are up. Yes. I think if you're a believer that these rents are here to stay and they're not going to go, then if rents are here to stay and interest rates are high right now, right? Let's say interest rates are high. I'm buying right now because the rents aren't going to go down, but guess what? The interest rates will. And if you think the rents are staying and interest rates go down in 5 years back down to like 3.5, you just made a lot of money.
Do you think that like maybe just like dumbing it down, do you think part of like the reason people are buying right now is just because you always hear the adage that real estate is a good hedge against inflation?
Yeah.
So like, do you think that's why people are buying? Like
there's people buying. There's people that I really, really respect buying right now heavily, and they were not buying like this a year ago. Why?
Or 3 years ago?
Yeah, or 3 years ago. But 2021, I think, was an interesting year. I mean, it was a great year for brokers. There was a ton of transactions. Every broker I know made the most they've ever made last year, or definitely one of their top 3 years.
Yeah, interest rates were low and
people were buying like crazy. There's buyers that are buying like crazy now that were not buying like crazy then. Mm. I think everything was easy. When things are easy, it was good.
I think there's uncertainty in the market. Whenever there's uncertainty, people sit on the sidelines. And I think people are going to look back and be like, I missed another opportunity.
It's like 2020, best year of your life to buy deals.
Well, I think we did have a big pause in the market like 2 months ago, but I think now as I feel like things are kind of settling in, like I'm getting more inbound buyer inquiries on transactions than I've ever gotten.
That's true.
Like I'm having more random people kind of call me and just say, hey, like I'm looking for this. And they have like pretty specific criteria in terms of like locations, what they're looking for, like going in yield on whatever. And I've just found that to be really interesting because I'm getting a handful of calls every day on it. And it's been interesting, like trying to start work with some buyers I've never really transacted with.
So we mentioned the amount of demand on the rent side, but do you feel like there's also a lot of demand and a lot of liquidity and just a lot of capital looking to be placed on the acquisition side as well? Or do you feel like some of that dried up, like the stock market's down? Like where are you guys on that?
Slowed down.
Stock market's kind of up again.
It's weird though. My
Yes and no,
intuition
mixed.
said it's slowed down, but my
The numbers,
my broker side and the
internal-
number side, the numbers are good. The market's good.
Our
Everything's good.
numbers in terms of our listings and our deals going under contract tells a very different story. We're putting so many deals under contract right now. It's like multiple deals per week.
That's why this environment's so interesting to me. And the answer of who's winning the battle, rates or rents, is so interesting.
Well, so Derek,
Do you have a take on it? Do you have an answer?
I think the rents are winning the battle.
Yeah.
In terms of New York City real estate. And I think rates are winning the battle for buyers' mindset. I just think for whatever reason they're getting hesitant.
Rates are winning on the rent stabilized stuff.
I
don't think they're winning enough. I honestly think
Yeah.
where interest rates are today, if you go to a bank with a 6-family or an 8-family rent stabilized building, I'm not even talking about LTV, just on an interest rate. I think cap rates should be higher for what you have to deal with.
The rent stabilized?
Yeah.
Yeah.
I honestly think the cap rates are too close to interest rates, but that's our job to do that.
You want to know what's completely crazy? So I'm selling the store right now. It's a sub rehab renovated.
Yeah.
8-family in Park Slope. 8-family.
Yeah.
It's going for $1,500 a foot.
Yeah.
$1,500 per foot for an apartment building.
Yeah.
And then you can have like a 20-unit building that sells for like $100, $150, $200 a foot. Like it's just like the tale of two completely different markets.
And things will change.
People are buying stabilization now for cost basis. That's it.
Which makes sense.
Got it.
They're buying the bricks.
Yeah.
There's no other reason to buy it. You're hoping for a shinier day with that product type.
Which will come because things don't make sense right now and at all from a number of levels.
Yeah, I mean, one of the other bigger trends that I've started to notice is that landlords that own 5 to 50 50 units plus in terms of number of properties that they own, like I'm starting to see a lot of these guys start taking some chips off the table, and people that are starting to sell, parts of their portfolios in New York because of the political risk and potential changes to, good cause eviction in the future or any other kind of political changes in New York. I'm starting to see that those are some of the sellers that are emerging now that previously had not been people that were in the market. And I'm starting to see those people are transacting at this point. So I found that to be kind of an interesting trend recently. Whereas you're mentioning we're putting 1 to 2 buildings in contract a week.
More.
Right, 1 to 3. So like what, in terms of like, the sellers, like what kind of profiles are these types of people?
It's anything and everything.
Yeah.
I feel like there's just a lot of people, like, I think it was pretty clear over the past couple months that like interest rates go up quickly and prices go down, like kind of universally, unless there's like rents that go up or whatever. So I think there's a lot of sellers that saw interest rates going up so quick and they saw what that does to their value like instantaneously. And I think there's a lot of those people that think that we still have a ways to go in terms of where interest rates are going. And I happen to be on that side. I think interest rates are going to continue to go up for quite some time. I'm not sure how high that'll be, but I don't think we're there yet. So I think for a lot of people that were considering selling, they almost started to like rush to the exits. And I also found it interesting because there's buyers with capital where you'd think that buyers are really like, oh, well, the market's coming down, prices are coming down, I'm just going to sit back and wait. But that wasn't the case. There's people that were like actively looking to deploy their capital, and we saw buyers rushing to sign contracts because they wanted to lock in their financing and their interest rates, like, and get like a better rate before rates went up. And they knew if the rates went up, it would hurt their price, and then potentially the seller wouldn't sell. So like the past month or two is just like a rush to like do transactions, which I found very interesting.
I think they're looking to take advantage of an opportunity. I mean,
buyers, sellers, both.
The buyers that are jumping on those opportunities, because right now, and again, it goes back to the rates and rents, but prices are artificially low because of interest rates. Now, let's say
high?
Lower than they should be because of the rental market.
Got it.
What I think is, I think these guys are looking and saying, if I buy this today, and like Luke said before, if the rates go down in 2 to 3 years, and the rents are still going up, in my opinion, call me an optimist, but I don't see any reason why that's going to change.
Yeah, I agree.
It's a supply and demand issue, and they're gonna make a pretty penny in a couple of years from now.
That's
buy now, lock in long-term financing. With whatever happens, they go up, rates go down.
With a market rate, easy, no headache deal.
I mean, listen, that's
sure.
And that's it.
And ride the market.
Ride the market. That's all. That's what I think those buyers are doing. I think
and you get the principal reduction, and you get the depreciation, and the cash flow, and potential appreciation. Like these could 100%. All be very good deals over a 5 to 7 year period.
That's what I think. That's why I think now is going to be one of the better opportunities you see to get easy deals in New York City.
You can always you can always refinance. If a deal makes sense today at higher rates, wait until you see it with a point less.
And even if they don't go down.
Assuming you get there.
But you will. This is long-term stuff. I mean, I think Adam brought up...
long-term, I think rates will be low.
Yeah. Adam brought up the East Village package.
Even if they don't. Look at rents.
Even if they don't. You're right. But I think they will. Mm-hmm. Eventually, I mean, obviously it's never a fact, but like Adam brought up the East Village package that we're probably putting under contract today or tomorrow, or should be, right? The guy who's buying that, not to name names, like obviously a smart guy, young, like I guarantee that's exactly what he's doing. He's buying good product. The rents are where they are today. The rates might be a little high. He's gonna keep. He doesn't see rents going down at all. And yeah, listen, if rates go back down, he's looking really good. And he could refinance and have even a higher cap rate. But he's locking in a nice cap rate right now, in my opinion, in the East Village.
And look, high rates in some way can be good for multifamily because the renters that are occupying these buildings cannot afford a home.
Fact.
You know, they just can't.
So it keeps renters in the market.
Keeps renters in the market.
Definitely.
I think there's more renters. I don't have the numbers to back it up, but there's more renters in today's market than I think.
It's not easy to buy a home.
Do you guys think?
Peel that back.
So I used to be of the mindset that renting was a much better deal than owning, like a condo or a townhouse or anything along those lines. And then interest rates went so damn low, like during COVID, that everyone rushed.
Yeah.
Everyone rushed to buy it because it became.
He was tempted.
It actually switched.
Yeah.
It became a more affordable on a month-to-month basis to buy than to rent.
Yeah.
But now, are we back into the environment where renting is still a better bargain?
Yes.
Than owning?
So I'll take that. So recently, I was just like, maybe I'll buy a 1-bedroom, just like everyone else. You know, and call it my rent's like around $4,000 a month. To get a $1.2 million condo in Manhattan with the HOA fees and the taxes, like you're looking at like a $9,000 to $11,000 per month payment.
Is the unit a comp for your current rental?
Yeah.
Like in terms of like a unit.
I live in an elevator, nice 1-bedroom with a balcony. It's a nice property. Yeah, obviously the kitchens and bathrooms could be a tad updated, but in similar type of product, maybe the condo had $30,000, $40,000 of upkeep to it. But the truth is if I could rent for $4,000, $4,500 today, or I'm jumping into $10,000 a month just to be an owner, it doesn't make any sense.
Doesn't make any sense.
And also to put down the 25% down, I mean, you're looking at a $300,000, $400,000,
for sure. And you're out of pocket with that money where you could go and do other stuff with.
And if you're in our industry, right, which that's what we're dealing with on a day-to-day basis, real estate investors, most real estate investors, unless they're very, very wealthy, call it 10 million, 20 million and up net worths, they're renting. They're renting and they're putting their down payment money, so to say, in assets that go up in value and that create cash flow. That they understand. So not only and this is my opinion, not only are owning a home in New York, even that's more expensive than the payment every month when owning is more than renting, and that doesn't take into consideration the down payment that you're putting down and what opportunities are you losing by you're buying a place for $2 million.
Opportunity cost of your capital.
$2 million in the city today is not what it used to be. So $2 million bucks, that's $500,000 down on a good day, and then you're also paying a lot to live there every month with insurance, tax, and HOA fee.
Yeah.
What are you missing out with that $500,000 locked into that house? What kind of opportunities could you invest in with that $500,000?
Yeah.
There's an opportunity cost there, a huge one. So I'm a renter in New York City.
Got it. You and a lot of other people.
Yeah.
You and all the people waiting around the corner.
Yeah. For sure.
But whatever. It's a better trade-off.
Yeah.
I'm agreeing with you.
So
Can't beat it.
all right, let me ask you guys this question. Let's change topics a little bit. So, like, in terms of the market right now, you have all sorts of different asset classes. You have free market, you have mixed use, you have the properties where it's somewhat free market, somewhat rent stabilized. You have the rent stabilized. You have whatever, retail, land. Where do you guys see the best opportunities in the market at this time?
Who wants to take this?
I mean, I have my thoughts on it, but
Give us your thoughts.
well, I mean, okay, so what's the best opportunity in the market? I love the unrenovated free market properties where they're occupied and you have tenants that are there, where I feel like you could probably put some kind of cap rate on it.
Yeah.
Whatever the cap rate is. But the units are not renovated and the rents are below market. So I feel like if you can turn those units over and renovate, I feel like you might be able to buy that product, that free market product, at a discount to its end, like its finished product value. So I think that's a really interesting play. I love the to-be rent stabilized asset class for the same reason, because you can get a 6-family in a great location for like $1 million. It could be worth $2.5 million vacant. So and you can get it at like a 5 or a 6 cap. So I mean, obviously there's a lot of risk there, and you don't want to get into the ballpark of like tenant harassment or anything along those lines. But there's also a huge amount of potential that you could unlock if the property turns over, or even if on the rent stabilized side, it doesn't even need to be the whole property. It could be part of the property. So I like that stuff a lot. I feel like where the opportunity is in the current market is turning over units and renovating them to so you can get the market rent,
Free market apartments.
whatever that looks like.
Another thing to piggyback off what Derek was saying, like, you know, it's always looking at highest and best use, right? So I think a big trend that we've identified, and I think a lot of people are really starting to exploit, are taking these unrenovated types of properties and reconfiguring them to be sold ultimately to like a home buyer,
And
right?
usually, yeah.
Yeah, so like the reality is a lot of the people looking for these beautiful brownstones in Brooklyn or in Harlem, et cetera, like they don't want to do the work. And they're willing to pay a premium to walk into a gorgeously renovated type of property. And I think if you're able to get, as you mentioned, like a free market type of building, even a 1 to 5 unit building, and reconfigure it so that it can be exited to a user who's not necessarily looking for as much yield, and they're willing to pay, you know, a much higher price than any type of investor, I think that's also a good segment of the market right now.
I think what you said, I agree with.
Yeah.
The first point, I think the best opportunity today in good locations, core Brooklyn, core Manhattan, whatever it is, it's probably really hard in Manhattan, but core Brooklyn, let's say, free market product that has been owned by someone for a long time with unrenovated free market apartments that are occupied. And I say occupied because obviously there's headaches with that, but a lot of buyers, they're afraid of that. And rightfully so. It's way easier said than done to getting a free market apartment vacant.
It's not a sure thing.
Not at all
that
sure thing.
That you can turn the property over. Like
not
a
at all.
vacant building is a very clear path, and all you have to do is run the numbers
Massive
in terms
premium.
of what it's going to be worth when it's done, your cost of construction to get there, what your time is worth, what the risk, you know, associated with the deal is worth. But when it's occupied, there's no guarantee that you can get it to like that finished product stage.
And it's going to take time and money, and you can get really lucky. Listen, if you could buy a deal that other people won't buy, and a lot of the markets raise capital, and time is money for them.
I'll actually add one more thing. You said occupied free market, but did you say below market rents? Like if they're rented at below market rents, and you could put like a cap rate on those deals, and they're occupied, like that's where you can get.
Well, they're going to be below market because they're unrenovated.
Market value.
They're going to be below market because they're unrenovated, and if you're buying,
good point.
They're always going to be like that, and there is a risk for that, because especially in these, call it Carroll Gardens, Cobble Hill, Park Slope, Williamsburg, Greenpoint, these markets, these people don't have places to go. So if you buy a free market deal that's unrenovated and you expect people to leave, you better keep thinking. I mean, it's tough. It's. I think the under market free market apartment play is the old rent stabilized.
Of course
play.
it is. Yep.
It is the old rent stabilized. It's for the cowboys that, you know, can get in and gets people out.
I'll take
It is.
I'll take it a
that's
step
where the fun
further,
is.
though.
Yeah.
I agree with everything you said, except I'll put a twist on it.
Yeah.
and I think it's something that's dominated this conversation, is core markets.
Yeah.
I think the opportunity is actually the same product, but in tertiary markets. You have so much demand right now. Everyone talks about it.
Yeah.
These core markets, where these markets were on that in these tertiary areas that are like, you know, the Bushwick, Bed-Stuy, Crown Heights, that were on the forefront of, you know, get in back in the rent stabilized days, raise the rents, make a killing.
Yeah.
The buyer pool has shrunk and the demand has shrunk. So I think you're going to get not only a discount on going in price, but you're going to get an increase. I think you can decrease your risk by getting a higher going in cap rate day one, just because the demand is lower.
I agree.
And it's the same business model.
I was gonna say, well, like, what about, like, I know, Derek, you've been selling a lot of, like, you know, 421A abated new construction properties that actually have a decent rents in place, right? So if someone's actually betting that the RGB is going to increase the increases of what they're able to actually increase those rent from, and you have a much higher legal rent on most of those units, like, perhaps that's actually an interesting play.
That's an interesting play for sure.
Because you'd be buying into like a 420A deal with, you know, going in at X cap, but, you know, if RGB increases to 5% next year and you're getting the rents at $3,000, but it's stabilized still, and that can go to, you know, the few $100s more. Like, maybe that is a really interesting segment of the market.
That is a very interesting segment, especially for the affordable New York, which is the 35-year 420A, and if the developer did that right, it's 70% free market, 30% rent stabilized. So the 70% free market can ride, you know, and especially if you can buy those on, like, I mean, if they still exist, the COVID rents, and then you have the RGB for the rent stabilized component. Those could be very good deals.
Yep,
I agree.
The truth is, a lot of those don't sell for whatever reason.
There's a disconnect between sellers and buyers.
Mostly on the tax savings, though, right? That's the
but I mean, people don't really talk about the tax savings on the 35 years. It's like all sellers are gonna be like, they're gonna be like, dude, 35 years. Like, what are you talking about?
So many cycles of refinancing and in between.
And the buyers, I don't know. I mean, I don't know if the buyers are quantifying the 35 years. But there obviously is a very big tax increase exposure way down the road.
Right.
I don't know how buyers are quantifying that. I mean, the way to do it is obviously discount cash flow, but those deals really, not a lot of those are selling.
I don't think the market, I think we could all agree on this. Most of the market, these guys are value add guys. So I think that's a lot of the players, and I don't think these are value add deals. I think it's more of you know, place your money in. Obviously, the cap rate makes sense day one and hope for rent growth, but these guys that are buying are looking to make money, and they're value add. So I think it's hard. I think there's a smaller buyer pool for this finished stuff.
I mean, we just sold a I think it was 28 units on Pacific Street. That was a 15-year 420A. It had maybe, I don't know, 11 years left.
It's a 1031 buyer though.
He actually wasn't 1031. No, he wasn't. And I mean, he got a decent cap rate. I don't know if he's calculating the tax increase exposure, but we just sold that, and that deal happened really quickly and efficiently. And you know, the truth is, like, these 420A deals, like, in terms of price per unit and price per foot, like, they sell for very affordable numbers in terms of like how to get there.
Yeah.
So yeah, all right. What else do you guys want to talk about? Anything else? Do you want to go over? I have one last question here.
What's the last question?
Yeah.
And maybe we already hit on a lot of this, but just like what are like the most interesting things you're seeing in the market, or like anything interesting that's coming to mind based on where we're at this time?
I want to go back to what Steve said about the tertiary location, and it's not even tertiary. I mean, this was not tertiary, you know, a couple years ago, but Bushwick, these areas, Bushwick's a phenomenal market, and there is a big disconnect between the value I believe these buildings to be worth and buyers. I think everyone's chasing that sexy rent pop. That's why everyone wants the core areas. They're like, oh, if you can turn over a free market unit and we, you know, gut it, we're gonna triple the rent because the rents are so crazy, and they're forgetting about these other markets. But cap rates have gone up a ton, and these are good core locations on subways. You know, good Bushwick, good Bed-Stuy, whatever it is. I mean, there's opportunity. When people aren't looking, that's inherent opportunity, and they're missing out. Bushwick is a buy right now. I mean, it really is. There's
100%.
good. There's good.
That's what I'm saying. People are turning a blind eye for whatever reason it may be. Whether it's they see the opportunities elsewhere, but I completely agree. That's where the market is.
Agreed.
I also think what's interesting is I do think renovated product has become extremely attractive.
Yeah.
Once the rent laws passed and people have seen this rent growth and the potential, right? You can go in, even I take it even a step back. We're seeing institutional players buying 3 families in some of these markets where 5 years ago, if you told me to sell a 3-family, I almost would have to turn it down.
Dude, these are better than any abated deal. Your taxes are capped, and they're free markets. You can ride all the inflation and the rent growth.
I had 2 buyers call me this week about 2 over ones, 2 apartments in a store.
It's become a very small market in sense
definitely.
of asset types. And then if you can get a larger building at a good cost basis, there's the opportunity there. If you believe in sunnier days for the rent laws, which with the way the rents are and the vacancy holdouts for some of these units, it's going to have to change.
There's so many warehouse units. That's another part that we didn't even talk about. How many warehouse units are contributing to the rent growth?
A ton.
I mean,
People say it's 20 to 40,000. I have no way of knowing.
Even
but
if those numbers are correct, it's how many units are not becoming renovated.
yeah. That's why I said
That's
things
what's-
will change. It doesn't make sense.
That's
They're
why-
hurting themselves.
As much as we knock rent stabilization, it could be, depending on price point, a good buy.
for sure it could.
It's my second favorite opportunity. It's not my first, but it's my second.
Good,
because
great cost basis.
most people want, there's not a path day one to make money. Derek always says this, what's the play? How do you get your money out? What do you do?
What's the path?
What's the path? I'm sorry. What's the path? There isn't really a path for rent stabilized units, but there's a basis.
It's a prayer.
But you got to make those bets. All the groups that are just buying core and undervalued free market apartments. Yeah, there's an obvious play there, but you also have to put some chips on the rent stabilized stuff. It's got to be clean.
Every year
it's got to be clean.
I put money in my retirement account. I hate it.
What's the difference?
But you got to do it.
Yeah.
So it's just it's interesting. Because that stuff after 2019 wasn't even looked at.
Adam, anything interesting you're seeing?
No, I think you guys have really hit on everything. I mean,
I have 2 things.
Yeah, obviously, I think the covered land plays are still really interesting. If you can get a
I
deal
love
with
that.
a
It's a
potential
good point.
redevelopment or potential assemblage opportunity, I
Are
also
we
think
seeing that though with no 421A? I feel like a lot
But
of
it makes
stuff-
sense though. I
it
like that.
makes
Yeah.
That's the first time I
perfect
thought
sense.
of it.
Yeah.
The
Yeah.
other play I think is really interesting is if you believe that the retail market's rebounded, which I do think it has. I think things are renting at higher than pre-COVID levels in terms of the leases that I'm seeing. We don't obviously focus on that, but from what I've read, I think if you're able to buy a property with a shorter end term on the retail space, and you do believe that the retail can increase by 10, 20, 30%, and you're already at a decent cap rate day one with upside in some portion of the properties, those are obviously very interesting deals too. Because banks will obviously finance favorably for those as well. So, I don't know. I think the market is just so interesting and so complex. Yet it's an unbelievable opportunity for both buyers and sellers.
for sure.
And it's a great opportunity to be a broker too, because you really get insight on you're in the trenches. You're
So
really
many moving pieces.
It's fascinating the amount of moving pieces. But I think having good partners and be able to talk through deals and really strategize on stuff's really helped us get so many of these contracts signed, and it's an incredible market. I foresee it to be unbelievably strong given the next 4 to 5 months of this year. I think it's going to be a fantastic market for everyone.
I agree with you. I'm gonna add one thing too. I mean, I think the groups you see winning today, like the small syndicated groups that are raising money that are buying these small buildings that they hope to get vacant or wherever they're renovating free market apartments. I think construction's winning. I think if you have people don't talk about it. Obviously, we're here to sell deals, and we're dealing with people that are buying deals. But construction is such a huge part of our business. I honestly think it could make or break a deal. And there are groups that are buying heavily right now that have the construction down packed, and it's allowing them to pay extra money. People think they're paying big numbers, but you know what? It may look like someone's paying a big number on the service, but if they have the construction figured out to a T, they're going to far surpass anyone that bought that deal for $300,000 less.
I was speaking with a developer not too long ago,
Yeah.
a guy that builds ground up.
Yeah.
And he was saying that the cost of the acquisition of the land, I forget the percentage, but it is such a small percentage of
Yep.
the overall deal that to the point where it doesn't really matter. they have so many, like to build a building from the ground up or even like an existing building where you're gut renovating, alt 1, alt 2 type of stuff. But like you're dead on. Like people that have the team and the processes and control the construction can pay prices that other people couldn't fathom.
And it makes sense why they can. Everyone knows it can, a botched construction job can cost you so much more. You know,
For sure.
Not at the cost.
Yeah, I was gonna
Price
say,
today.
Yeah, perhaps they actually have equity partners or getting debted international debt and getting cheaper debt than what other people might be able to get as well.
That's a good point too.
These guys have the construction figured out. The guys know what they're doing, have the construction figured out. You have to. And a lot of people I'm seeing go in-house where they're creating construction crews. Because it's a hard business to really do well in if you don't have the construction done packed.
Yeah, no, so just the two things that I have that I find interesting that we're dealing with right now in the summer. Number one, tenants writing love letters to the landlord. Like basically begging to like be approved. Like what you hear about like in like home sales in New Jersey where like the couple writes like a love letter and says, hey, this is us and here's our dog and here's our kid. Tenants are doing that.
Didn't you hear stories of someone sending pictures of like their rabbits to one of the landlords?
I'm looking at an apartment tomorrow in Tribeca, and I'm going to prep a love letter for tomorrow.
You should.
I am.
It's a good idea.
It's going to be a picture of me, my wife, my kid. It's going to be nice.
Yeah.
You know,
Picture of you guys out at the Hamptons.
Yeah. It's going to be
wearing-
good. Like we're good people. Come on,
Matching
rent
outfits.
to us, please.
You're like,
It's going to happen.
I swear I'll pay you.
Yeah.
I swear I won't.
Yeah.
And the last thing, so we're dealing with, you know, the taxes are due for the LLCs in a month.
Yeah.
And, you know, I'm just reminded of like what an amazing profession this is to be a real estate broker, to have access to all these transactions and these buyers and sellers. And
Yep.
I think the industry is incredible. And the tax law, as a real estate professional, the tax law pushes you to also being investors. So, I mean, we've bought a handful of buildings over time, and it's just so beneficial. The benefits you get for owning real estate, being a real estate participant. Like the tax code is so clearly in our favor.
For sure.
So I just love that.
I could not agree more. That's why you want to get started in this early and young and start building. Because if you can get in young and build, it is very beneficial. The career is being in real estate, period. I mean, I think it is the best tool to invest in.
The depreciation aspect of real estate
Yeah.
and the fact that as a real estate professional, there's no limit to the amount of losses that you can write off.
Oh, yeah. Not to mention you can
other-
accelerate the depreciation.
Yeah, there's
It's
just there's just so many favorable avenues that like it's just such an awesome profession.
Well, and plus, you obviously have the whole entire 1031 aspect that we haven't
Yeah.
even talked about at all. But
For sure.
and that's just
Topic for another day.
unbelievable.
Definitely a
loophole
topic for
right
another
now,
day.
but,
Real
yeah,
estate
but
is
you're-
just so many avenues and opportunities. All right, so thanks for listening.
Yep.
And hope to be in touch.
Yeah. All right.
All right.
Good.
Thanks, guys.